The debt-to-assets ratio is a key financial metric used to evaluate a company's financial leverage. It measures the proportion of a company's total assets that are financed by debt. This ratio is crucial for understanding the level of financial risk a company is taking on, as it highlights the extent to which the company relies on borrowed funds versus equity to support its assets. Debt-to-assets ratio. The debt-to-assets ratio provides insight into a company's overall financial stability by comparing its total debt to its total assets. This ratio is particularly useful when compared to other financial ratios because it specifically focuses on leverage, showing the proportion of assets that are covered by debt. Unlike liquidity ratios, which measure a company's ability to meet short-term obligations, or profitability ratios, which assess how well a company generates profit relative to its revenue or assets, the debt-to-assets ratio zeroes in on the long-term financial structure. This can be crucial for investors and creditors who are concerned about the company's long-term solvency and risk of default. To calculate the debt-to-assets ratio, you first need to determine the total amount of debt the company has. This includes all types of debt, such as short-term loans, long-term bonds, and other financial obligations. Then, find the total assets of the company, which includes everything the company owns, such as cash, inventory, equipment, and property. Divide the total debt by the total assets to get the ratio. This will give you the proportion of the company's assets that are financed through debt. Example: imagine a company with total assets worth $1 million and total debt of $400,000. To calculate the debt-to-assets ratio, divide the total debt, $400,000, by the total assets, $1 million. The ratio is 0.40 or 40%. This means that 40% of the company's assets are financed by debt. If the ratio is higher, it indicates a greater reliance on debt, which might imply higher financial risk. Conversely, a lower ratio indicates a more conservative approach with less reliance on debt. Low debt-to-assets ratio. A low debt-to-assets ratio generally indicates a lower level of financial risk. This means the company relies less on borrowed funds to finance its assets, suggesting that it may be in a stronger financial position with lower debt obligations. This can be attractive to investors and creditors as it implies greater financial stability and lower risk of default. However, it could also suggest that the company is not taking full advantage of leverage to grow its business. High debt-to-assets ratio. A high debt-to-assets ratio indicates that a larger portion of the company's assets is financed through debt. This implies higher financial risk, as the company has more obligations to meet, which can be concerning for investors and creditors. High leverage can amplify returns, but also increases the risk of financial distress, particularly if the company's earnings are not sufficient to cover its debt payments. This may make the company more vulnerable during economic downturns or periods of financial difficulty. How can companies optimize the debt-to-assets ratio? Increase equity financing. Companies can reduce their debt-to-assets ratio by increasing their equity financing. This can be done by issuing new shares or retaining more earnings rather than taking on additional debt. Reduce debt levels. Paying down existing debt will decrease the total debt figure, thus lowering the ratio. This can be achieved through improved cash flow management and strategic repayment plans. Improve asset base. Increasing total assets without a proportional increase in debt will lower the ratio. This can be accomplished by acquiring more assets through equity financing or other non-debt methods. Key takeaways. The debt-to-assets ratio is a critical indicator of a company's leverage and financial stability. It shows how much of a company's assets are financed by debt, providing insights into financial risk and leverage. A low ratio indicates lower financial risk and reliance on debt, which can signal financial stability. A high ratio suggests higher financial risk and greater reliance on debt, which may pose concerns for investors and creditors. Companies can optimize this ratio by increasing equity financing, reducing debt levels, and improving their asset base.